Big news in precious metals. In just 2 days, gold has shot up 15.6% from Monday's lows, and silver has jumped 26%. That's nearly $6 trillion added back to the market in 48 hours. Gold alone rose almost $700 per ounce, and today it's back above $5,000 per ounce. But there's more going on behind the scenes than the price charts are showing. Hello everyone, welcome to John AG Expert. My name is John, and I have over 10 years of hands-on experience in the silver and gold markets. On this channel, you'll get honest market analysis, clear price action insights, and practical trading and investment guidance. No hype, no false promises. If you're serious about silver and gold, you're in the right place. Don't forget to subscribe. And now let's get back to the market update. Silver is disappearing fast. In just 1 day, nearly 6% of silver left the vaults. In China, massive buying caused bank apps to crash, leaving people unable to buy even when they wanted to. This isn't about the price, it's about access. Paper markets might show supply, but reality is telling a different story. Physical metal is vanishing first, and the price adjusts later. Young investors in China aren't necessarily smart or dumb. They're reacting to uncertainty and choosing real, tangible assets over paper promises. When even bank-backed gold products become hard to access, that's not a glitch. It's a signal that demand is real and supply is tight. Here's the snapshot. Silver Western Spot, $90. Shanghai Spot, $104. Shanghai Futures, $101. Shanghai Premium, $14, 16%. And gold, $5,050. Meanwhile, COMEX and silver vaults are reporting withdrawals across the board, 2 million ounces Monday, including large withdrawals from Asahi, Brinks, HSBC, and JP Morgan. Total COMEX silver is down 1.84 million ounces, confirming the physical market is tightening while paper prices recover. Let's zoom in on China. This is where things get really interesting. While paper silver prices are climbing, the vaults are draining fast. On the Shanghai Futures Exchange, SHFE, silver inventories dropped 26.12 kilograms in a single day. On the Shanghai Gold Exchange, SGE, 11,295 kilograms disappeared in a week. This isn't speculation. These are real withdrawals. Paper markets can talk all they want, but vaults don't lie. When prices go up and inventories drop, the message is simple. Supply is tight, demand is real, and delivery matters. This is how paper pricing can break quietly, then suddenly. Meanwhile, the U.S. is moving fast on the geopolitical side. Washington just hosted the Critical Minerals Ministerial, with over 50 nations participating. The goal? Reduce China's dominance over essential minerals, especially silver, now officially classified as a critical mineral. President Trump recently announced Project Vault, a $12 billion strategic stockpile for critical minerals, backed by $10 billion from the Export-Import Bank plus private funds. It's basically the Strategic Petroleum Reserve, but for metals essential to defense, tech, and EVs. This ensures that U.S. manufacturers are protected from shortages and foreign leverage. Silver's upgrade to critical status is a huge deal. It unlocks federal incentives, faster permitting, and priority in national security projects. This isn't just about a shiny metal anymore. It is now a strategic asset in America's national defense playbook. On the international stage, friendshoring is underway. Countries like Australia, Canada, South Korea, India, and members of the EU are lining up deals to secure and process critical minerals. Capital is being mobilized, projects are being fast-tracked, and priorities are being set quickly. Now let's talk about the U.S. markets, where things are getting intense. On COMEX, silver vaults are being drained. On Monday alone, 2 million ounces of silver left the vaults, millions more across Asahi, Brinks, HSBC, and JP Morgan. Total registered silver dropped to 103 million ounces, while total COMEX silver fell to 403 million ounces. That's 5.9% of silver disappearing in just 1 day. This isn't hype. These are documented withdrawals. Meanwhile, the paper market is recovering, but the physical metal is leaving the system. Paper and physical are moving in opposite directions. All the hot money speculators are gone. Open interest has collapsed, both in gold and silver. What's left? Banks covering their short positions, often scrambling like it's hot potatoes. During the last crash, paper shorts were forced to deliver physical silver, which is highly unusual. Normally only 1 to 3% of contracts are taken for delivery. This time, it was much higher. The key takeaway? The recent sell-off wasn't panic. It was a physical accumulation event. Buyers stepped in, demanded delivery, and scooped up metal while paper prices fell. Dubai is feeling it too. Silver there is trading at a 15% premium as demand rises. In China, bank apps are crashing because people are rushing to buy gold. This is a real squeeze. The system is showing that when paper markets move, physical fundamentals can tell a very different story. Vaults are draining, physical supply is tight, and paper prices are just starting to catch up. Here is where things get even bigger. The story isn't just markets. It is geopolitics. Governments are positioning for a future where access to critical minerals like silver could become a national security issue. Trump's administration isn't messing around. The Critical Minerals Ministerial brought over 50 nations together to reduce reliance on China for essential metals. At the same time, Project Vault, a $12 billion stockpile, is being built, backed by federal and private funds. Think of it like the Strategic Petroleum Reserve, but for metals that power tech, defense, EVs, and medical devices. Silver's upgrade to critical mineral status is huge. This isn't just a shiny collectible anymore, it's now a strategic asset. That means faster permits, federal incentives, and top priority in national security projects. Countries are friendshoring, making deals with Australia, Canada, India, South Korea, and the EU to secure supply chains. Capital is flowing, projects are speeding up, and the global race for metals is on. Meanwhile, the physical market keeps tightening. COMEX shorts are being covered, vaults are draining daily, and Dubai premiums are rising. China's bank apps can't even handle demand. The paper markets may be moving, but physical fundamentals are showing real scarcity. This isn't just about trading, it's about access to metals. If you can't take delivery, you don't actually own anything. Governments, investors, and buyers are all reacting to this tightening. The result? $6 trillion recovered in 2 days, gold back above $5,000, and silver up 26%, while physical supply is disappearing fast. Now let's talk about the risks that could shake everything up again. Japan's bond market is under serious pressure. At Tuesday's auction, demand for 10-year Japanese government bonds was weak. The bid-to-cover ratio fell to 3.02, below last month's 3.3 and the 12-month average of 3.24. Investors are nervous ahead of a national election on February 8th, where the ruling bloc could push more fiscal stimulus, potentially increasing government debt. The result? 10-year yields are spiking to 2.26%, the highest since 1999. Another key auction for 30-year bonds is coming up, and the world will be watching. If demand fails, Treasury yields around the globe could follow, triggering a risk-off reaction. Everything sells, metals included. Geopolitical tensions add more volatility. Talks with Iran are ongoing, and any military incident could cause immediate market shocks, followed by safe haven buying. Even so, the physical market fundamentals remain strong. Silver ETFs are recovering, open interest is at multi-month lows, and physical shortages are evident. Vaults are draining 5.9% daily. China can't buy gold due to crashing apps, and Dubai is trading silver at a 15% premium. Gold is back above $5,000, and those who shorted during the crash are now underwater. Bitcoin has fallen relative to gold, showing just how volatile and risk-sensitive these markets are. The key point: volatility isn't over, but the physical supply situation is increasingly tight. Paper markets can fluctuate, but real access to metal is where the real story lies. If you can't take delivery, the metal isn't really yours. Here's where we connect all the dots. In just 48 hours, the precious metals market has bounced back dramatically. Gold up 15.6% from Monday lows, silver up 26%. Nearly $6 trillion added back to market value. But this isn't just about price. Physical supply is tightening fast, vaults draining 5.9% daily. COMEX withdrew 2 million ounces Monday, with registered silver at 103 million ounces. Dubai premiums hitting 15%, China's bank apps crashing from gold demand. Meanwhile, governments are taking strategic action. Project Vault, $12 billion stockpile for critical minerals. Silver officially classified as a critical mineral for U.S. national security, over 50 nations cooperating to secure supply chains. Faster permits, federal incentives, and priority for defense and tech projects. Open interest in gold and silver is at multi-month lows. Hot money speculators are gone. Only banks covering shorts remain. During the crash, paper shorts were forced to deliver physical metal, showing the reality of tight supply. At the same time, risks remain. Japan's bond market under pressure, yields spiking, geopolitical tensions with Iran, ongoing more volatility possible in global markets. Here's the takeaway. Physical metal tells the real story. Paper prices may bounce, but if you can't access the metal, you don't truly own it. This is a market where physical demand leads and prices follow. Watch these signals closely. Vault withdrawals, access issues in China, Dubai premiums, open interest levels. The combination of tight physical supply, government stockpiles, and geopolitical moves could set the stage for a major sustained rally. But the risks are real. Volatility could spike again if Japan's bonds fail or tensions escalate. In short, the market has recovered quickly, but physical shortages are accelerating and global actions are signaling that governments see serious risk ahead. Know the risks, track access, and stay informed. The next wave could be historic.